Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending September 10th, 2021. I'm Preston Brent. Thanks for tuning in. Why don't we jump into this? It's really been an interesting week, I guess. Um, Short holiday week. Let's take a look at what's going on here. Uh, I've got a main thesis here. Is this the beginning? Meaning, are we going to go much lower, or are we going to find the buy the dip crowd coming back in and then propping us back up? Well, I'm going to show you a couple of key things on the charts that we've got to follow because it's been holding through or true for the entire year of 2021. And now, is it going to hold true this time? Well, I'll show you here in just 1 minute. But first up, let's just take a look this week at what we've seen, or this past trading week at what we've seen. You can see that everybody was in the red for the week. The Dow, S&P, Nasdaq, and the Russell all coming in down for the week. Year to date, we're still quite strong in double digits. A little over 13% for the Dow, 18% for the S&P, 17% for Nasdaq. Russell still double digit at 13%. The PE ratio is still elevated at 22.10, as you can see. S&P dividend yield is coming in at 1.31%, 10-year Treasury at 1.34, which sits a little bit higher than the dividend yield by just 3 basis points. The earnings yield for the S&P, which is essentially just reversing the calculation for the PE ratio. The earnings yield for the S&P is coming in at 4.5%, so that's still higher than the 10-year Treasury at 3.16. That's how much higher it is. So that still tends to funnel money into the S&P 500. Now the VIX, it moved up this week 27.8% for the week. The prior week it closed at 16.39. And this week we rounded out the holiday shortened week coming in at 20.95. So the VIX, we saw a little bit of volatility this week. Now, even the best and worst sector performers for this week were underwater. The best, just barely underwater, was discretionary at 34 basis points. The worst was real estate. But if we look at the annual sector performance, real estate has overtaken energy again, coming in at 30.26% year to date. Staples being the worst, but still up 7.84% for the week. Okay. So we've had some, the equities, the sentiment kind of weighed on equities this week. We had, not to mention September having a reputation for being a weak month for stocks. We had a big payroll miss. All right. That came in. Big payroll risk. We had the Delta variant, COVID blues, kind of slowing down some of the rebound. And I think kind of in a stealth mode, the Treasury Secretary, basically, that would be Janet Aunt B. Yellen, she said unless we do extraordinary measures to avoid breaking the congressionally mandated federal debt ceiling, it's going to run dry in early October. So we're going to see the legislatures, that would be the Republicans and Democrats, fight that out. And last time we had a big fight like that a few years ago, it pushed the markets down even more. On top of all of this, we've got inflation worries continuing to weigh on sentiment. Okay. And this past week, we saw some investment bank / Q3 GDP forecast from about 5.2 down to 3.5%. And then on top of that, if that's not enough, we got the Fed's Beige Book. They indicated a slight downshift in the economy. Really began in August timeframe. So we've got a number of things going on. Okay. And even more troubling, I think I saw a survey that said over 41% of all U.S. households use some form of government assistance to help pay monthly expenses. Now that can't keep going on. So all of this is going to come to a screeching halt. Now I'm still on record as saying we could have a little bit of a dip, anywhere between 5 and 10%, right? 7.5 seems to be the average, but we haven't had that in quite some time. I don't think we've had a 5% pullback this year in the S&P, although we did have a correction, official correction in the Russell this year. Okay. So if we kind of look at it and we look at the economic data, as I said before, inflation's back on everybody's mind with the PPI coming in at 70 basis points. It was up 70 basis points in August, right? That's above consensus expectations of 60 basis points. And we got a tight labor market, right? We had the job openings, labor turnover. I think they call it the JOLTS report. So record 10.9 million positions are available, waiting to be filled, right? No one's filling them, right? That's a million more than consensus estimates. It just shows how much employers need work. Now that's going to drive up the labor wage rate, which is going to drive inflation, and that tends to be more sticky, right? We did get weekly jobless claims fell more than forecast. We're now down to a pandemic era low of 310,000. Okay. Um, the other thing is on the U.S. Treasury front, the PPI tended to reverse the downward trend in interest rates and yield we saw this week, with it moving modestly higher for the week. The high yield or the junk market was also kind of quiet as we're getting concerns over economic growth and the Fed's eventual tapering. All right, keep in mind the Fed's are going to be meeting week after next, and I don't think they're going to start their taper, but they may talk about starting it. But the word is that they're going to start tapering. Remember, they're spending 120 billion a month, so, so they may start their tapering sometime in Q4, November or December. That's kind of where we're looking at here. Of course, if we look across Europe, pretty much Europe was in the red, as you can see. The Euro stocks, FTSE, CAC 40, DAX, all in the red, right? The CAC 40, the French index, leading the way year to date at 20.04%. Everybody's solidly in the green. And the Asian markets had a strong week this past week, while everybody else was down in a holiday shortened week. Asia was riding a strong. Look at the Nikkei, up very strong. If we look at it, you can see. Let's start first with the Asian or the European markets rather. The Queen Bee Lagarde, that's Christine Queen Bee Lagarde, the head of the ECB, basically said they're going to have a moderately lower pace of bond purchases. Remember, they're spending about 80 billion euros a month. We're spending 120 billion US dollars. They're spending 80 billion euros a month to help stimulate that economy. So what they're going to do is they're going to reduce it, but at a slower rate, right? So that was a dovish meeting. In fact, when they came out with their announcement, the U.S. markets moved up 10 or 15 points in the S&P right away after that announcement. They also raised their forecast for 2021 growth to about 5% from 4.6%. Okay. They did raise their inflation projection to 2.2%. Now their goal is 2%, but looks like they're going to run hot like the Feds here. At least kind of what they want to do. They believe that inflation is going to peak in Q4 of this year at 3.1%. We'll see. We'll see how that works itself out. And then, of course, if we move over to the Asian markets, right, and we look at, first of all, we look at Japan. They extended their gains this week, as you can see, really strong week, 4.3%. You know, a lot of it is on political optimism and expectations of further stimulus under a new prime minister, you know, because their current prime minister, Yoshihide Suga, he stepped down. So this new prime minister, it's hopes that he'll come in and be very dovish, right? Their second quarter GDP growth was also revised up to an annualized 1.9%. So they had a fairly strong week. And then, of course, looking at the Chinese markets, 3 weeks in a row that we've moved up in China. You know, that moved us into the green year to date. I mean, up 6.62%. The Asian markets are still trailing pretty much everybody else, but still they kind of came in strong. The other one that's really suffering is the Hang Seng, which is a Hong Kong market. And the PPI data over in China rose 9.5% in August from a year ago. It's at a 13-year high. So I do believe we're going to have some serious inflation coming into these markets. And I think more of it's going to be sticky than people think. What I want to do, let me just take you over to the charts here real quick and just kind of show you a good way to use these charts here to kind of determine, are we in a buy the dip mode? Or are we basically going to be seeing the buy the dip step aside, and we're going to see a little bit further pullback? So if we look at this market here, you can see the 50 EMA has been the line of demarcation where the buy the dip and the algos basically step in. Every time there's a green bar, green candle, right after the red candle when we move to or slightly below, right? Every time. This pattern has existed for the entire year of 2021. Now, as you guys know, especially those of you that follow technical analysis, patterns work until they don't work, right? So we're going to see this kind of work its way up very slowly, and then we're going to see it really come through here. So what I want to do is, if we look at this, and let me just kind of show you how far we are away from the 50 EMA. We're down right now, not much, about almost 2%, not that much from the all-time highs, roughly, okay? And then if we hit the 50 EMA, that puts us down about 3%, 2.9. That is not much, guys. We can hit that in another day or two. But if we do not see, and remember, you got to wait till we close because we close below the 50 EMA on this time and this time, right? So if we close below, we watch the next candle. If it is going to be red and we take out the low, going lower than the 50 EMA, then typically the move is 5 percentage points lower from there. So if we measure that, the 50 EMA is at 2.93. So just add 5% to it, and that puts us about 8% down. And if we go down about 8%, that puts us down right around 4189, call it 4200 roughly. So we've got some support points here. The 200 EMA is moving up. It's down about 10, a little over 10%. So that'll be our stopgap there. I don't think we'll get below that. I think it'll provide support. Our first key fib node, longer term fib node's 2.36%, sitting at 39.88. So call it 4,000. I don't think we will get that low on the E-mini futures. I do believe we can come down and see 7.5 to 8%, right? So either 42.20 or 41.50, somewhere in that area there, kind of in between this area is where I see us moving. Okay. If we don't see the buy the dip crowd come in, if I blow it up here just so that you can see, you can see every time that we hit the 50 EMA, there's a green bar right after. So the buy the dip crowd comes right in, right? If I move it again to the left, you can see red bar, then green bar, and then the buy the dip crowd takes us back up. We had a retest here, but again, we did not close below the 50 EMA. And I come back through here again, we went well below the 50 EMA, but a green bar moved us right back up. Same thing right here in January. And if we come all the way to January 1st, you can see every time we've hit the 50 EMA, there's a green candle right afterwards taking us back up over, okay? The last time we broke the 50 EMA and then we went lower, we went another 5%, okay? And the last, sizable move lower was when we had an official correction in September of last year, almost 1 year from now. We went down 10%. So here's what I'm going to have our members watching, all right, as we move lower. Here's the 50 EMA. So let's say we come down, and then let's say the 50 EMA kind of does this, and we close somewhere down in this area here. Well, you can expect if the buy the dip crowd comes back into play, the very next bar is going to take us up over the 50 EMA, and we'll close somewhere up here. That would be the buy the dip crowd's active, and then you'll see us move up pretty quick. We may even come down, test a 50 EMA, but we'd move up something like that, right? Kind of like in a 1, 2, 3 kind of pattern. However, if we move lower and then we have a pattern that looks, let me just clear my screen off. We have a pattern that looks something like this, where we come down, we move lower than the 50 EMA, and let's say that's the 50 EMA. We come up, we do a retest, but then we move lower and take out that prior low right there and move lower. Then the buy the dip crowd's not active. And we're going to find ourselves somewhere down in that area there, another 5% down. We'll probably test this. We'll move up, come down, test it, move lower, and we'll do one of those kind of patterns like that for a short period of time. Now, remember, September lasted about 3 weeks. We were moving down 3 weeks, and it only took about 3 weeks to get about 10% down. I don't think we'll move that far down, but we could see a number of moves. Keep in mind, we've had about 6 moves lower, greater than 5% since the pandemic low in March 2020. The average move lower when we've moved greater than 5% has only been 7.5%. That's been the average move lower when we break the 5% number, right? And that includes that 10% move in September. So this is going to be, again, a lot of this is already programmed into the algos, but we don't have the luxury of that, but we watch action around key support points. For us, the key support point for those of you that are swing trading or day trading is going to be the 50 EMA. It's as simple as that this time. Sometimes it's a little bit more difficult, but this time you can just, the pattern is just jumping right off the page. Now, if I can see it, Algo's got it programmed in. Everybody else can see it as well. So it could be a self-fulfilling prophecy. We will see how this thing plays itself out. If we look at Nasdaq, also over the 50 EMA, right? Up a little bit stronger. The 50 EMA, again, is going to be a support point where if we go below it, we're going to come down a little bit lower. Now, what has busted the 50 EMA is the Dow Futures. If we look at the Dow Futures, let's find them on here. Here's the Dow Futures. They fell 226 points on Friday. Notice we just blew right through the 50 EMA. Notice over here, the 50 EMA hadn't been as supportive as it has been for the S&P and Nasdaq. Over here, we actually blew below the 50 EMA, and in this particular case, we came down roughly about, that was about 3%, almost 4% below the 50 EMA, 3% below the 50 EMA. Right over here, when we went below it, but that doesn't count because the next bar was green. Remember, the first bar here right after the 50 EMA was red. So if we count from that point right there, which would be a more fair way to do it, we came down right at about 3%, roughly. Okay. Now that's the Dow. Right over here, if we were to use the same gauge and say right there, and we go down 3%, that would put us down right about there. Right about there. So down another 1,000 points, or down in a total of 1,000 points, takes us down to about 33,838. So about 700 or 800 points lower, right? Just to equal that kind of pullback right there. Now that's the Dow. The Dow is below the 50 EMA. Let's look at the Russell. The Russell is still stuck in a longer term sideways chop, as you can see in this shaded zone here. But it also has blown through the 50 EMA. But as you can see here, the 50 EMA has not been a good gauge for the Russell. Soon as we get up towards the top, the action has been to sell off. And then when we get down to the bottom, the action has been to buy, right? And you can just see we've been in this range going all the way back to late January. It's just a camel move. They move up, comes down, moves up, comes down. We've had multiple touches here on the bottom. You can see these long tails on these candles where it closes much higher, but we do those quick sell-offs and then it moves up into close. Again, this is a daily chart. So we're almost in the center, not quite, but almost in the center of this overall range. I have said that I think the risk of a break is probably more to the downside than the upside, but we'll see how this plays itself out, okay? If we look at the FANG index, which I built this custom index, which is comprised of Microsoft, Facebook, Apple, Netflix, Google, and Amazon, right? You can see we're near all-time highs. So the FANGs, money have been coming into the FANGs. You can see there's very little, if zero, divergence here, which suggests we're going to be in a buy the dip mode, right? And again, the 50 EMA on this custom index, the last time we broached it was back over here in May when we pull back a little bit more in the FANG index, okay? But right now, we're still solid. I think we still have some more downside moves, Momentum should carry us a little bit lower next week. And I think there's a little bit of fear of what the Feds are going to say coming up week after next. We got CPI data, which is inflationary data to consumer level, coming in at the tail end of next week. Remember, the PPI data said inflation is real strong at the business or the wholesale level. We're going to get the retail or consumer level on Friday. If it's high, it may put more pressure on the Feds. The markets already have baked in a little bit of stimulus reduction, but the Feds are already out saying they're going to leave interest rates where they are untouched through next year. So that does provide a dovish Fed for the markets. Eventually, this is all going to unwind. Right now, any dip, I'm instructing our members to have some cash on the sidelines to be ready to buy the dip. And as I showed you how we're going to tell, using the 50 EMA as the arbiter on is the buy the dip crowd jumping in or not. Bitcoin, we've got a specialized strategy we're using to play that. So it's almost like a no-lose strategy where we can do 8 to 9 to 1 in Bitcoin. If you're not a member, I highly encourage you to come in and check us out. It's really a lot of fun. We're doing well, making some money in these crazy markets. But you can see Bitcoin went up to the 61.8 fib node extension off the lows. And for those of you that are into technical analysis, historically, anytime you move up off the lows, 61.8% extension, very rarely do you come back down and retest these lows, okay? Typically what you'll get is a 3, 4, 5 pattern. You can see my system is already plotting out, a possible support point down around 42,900, 43,000 area. We could go a little bit lower, but I don't think we're going to get much lower than that. Then I think we'll have another run in Bitcoin, okay? And then, of course, as I mentioned, volatility moved up almost 28% this week. You can see the VIX coming back from the yellow into the red, right? We just have not been in the green all year long. Oh, in fact, last time we were in the green section on my vol chart was before the pandemic. If I take it all the way back, you can see we were in the green solidly back in January 24th, 2020. And then when COVID hit, away we went. And remember, when you have this kind of dislocation, we were in black swan territory, as you can see up here with the VIX. Once we get up in that area, it just takes a long time for it to come back down, right? Now, we've moved up from the choppy market zone to a down fast market. Now, that's how we ended Friday. Notice these are the spikes. The spikes seem to be making lower highs. If we take this spike out next week, it's going to run up to 30 really quick. So we need to watch it very closely just to kind of see how this thing's going to go. If we look at the front month vol skew, you can see in the front month vol skew, we closed in a backwardation. We're now in the front month skew in a backwardation mode. That means the VIX is higher than the front month vol futures. They generally finish, well, not generally, they always finish at 0 when the vol futures and the VIX, when the vol futures closes, it equals the VIX. So we've only got about a week or so to go. Actually, next Wednesday is when the vol futures expires, and then we move to another month. And looking at the back month of the volatility futures, which is basically comparing September and October volatility futures only, we're well ensconced in the green. So that tells me that the markets going out to October are just not that fearful right now. We don't have a backwardation in the skew. The skew is normal contango, which basically means that it's just a near-term fear right now of just a week or so, and then the buy the dip crowd is going to come back. That's what the volatility skew is saying. Now, that can change on a couple of hard down moves, but right now, going into this holiday shortened week, that's what the markets are indicating. And of course, if we look at the bond market, you can see the bonds, even with that hard down move on Friday, bonds also move down. There's going to be times, folks, when we don't have a situation where equities go down, bonds move up, right? That's a normal correlation. But because bonds and interest rates are so low, I do believe that up in this area here, you can see it's having trouble holding the 200 EMA. I've been suggesting to our members that we play bonds to the downside, right? Or interest rates to the upside. If we look at the 10-year rates, it actually moved up for the week, right? We're breaking the 50 EMA. I think the 10-year interest rate is going to be over 1.5, 1.6, 1.7 up in this area when we get to the end of the year, right? That would bode well for TLT puts or TBT calls. I prefer TLT versus TBT, right? But anyway, actually, the easiest way to trade is in bond futures. And members, we go through ways of doing that. In fact, we'll probably play one out this Sunday evening for our members. So these are just some of the ways that I can see that moving itself out. Currency-wise, well, longer term, the dollar is going to get weaker, but understand anytime you have a market dislocation, the dollar is going to want to stay strong. So I think this is just an opportunity to short the dollar, not go long the dollar. It's just going to roll over, right? When Europe starts getting back on its feet and get a firmer setting, you're going to see the dollar roll over. In fact, I think the dollar will move much lower. Longer term, short term, we got these spikes. It almost looks like a little bit of a head and shoulders formation here. We're not quite there yet, but let's see how this thing plays itself out, okay? And when I talk about a head and shoulders formation, something like this, right? You got the left shoulder, the head, and then probably the right shoulder. You draw the neckline, and then if it breaks lower, typically the distance from there to the neckline, and you measure that distance, that would be the distance of the fall somewhere down in that area there, giving us an Elliott wave 5 somewhere down there. That's a long fall. It's going to take time to get there, but that's where I think we're going to be eventually. So I like the idea of playing the euro long, not the euro short. That's the best way to play the dollar because the euro is about 58% of the value of the dollar. And it's really not the dollar, it's the dollar index, right? Because the dollar index is composed of the euro, the yen is about 14% roughly, the pound's about 12%, Canadian dollars about 9.1. You add all that stuff up, it's like 80% of the value of the dollar index. So wherever they go, the dollar index kind of goes the other way, right? So euro is the best way to play a dollar short. You want to play the euro long. You can see here an Elliott wave count. It's just the opposite. It's showing the Elliott wave 5 coming up here, matching these highs back up there. So doing a longer term bull run on the euro to me makes sense, right? So these are some of the trades that for our members I like basically, and it's just we'll go into details on how we do it so we minimize downside risk if we get it wrong. Okay, gold is just stuck in this wild sideways symmetrical pattern, triangle pattern right here. You can see this pattern that we're stuck in. I do believe that if we do break to the downside, we're going to come down and test this again. Longer term, I'm bullish gold. Short term, it's anybody's guess. We got a trade in gold, doing what are our specials, but it's a longer term trade. We'll just roll it out and see which way it wants to go. Same thing with silver, right? Same thing with silver. Copper, we've got some interesting trade on copper. We got into copper. As I tell everybody, we came out with a list, or I came out with a list of about 10 assets to go long in second week of April, right after the COVID crisis last year, and copper is just one of them. Keep in mind that about 40% of a car, or let me say it another way. On all EV, electric vehicles, it uses 40% more copper than a gas-powered vehicle. And the percentage of EV to gas-powered vehicles is only going to go up over the next decade. And that's going to tend to be bullish copper. Copper's trying to hold up this upsloping trend line. As you can see, this green line, if we zoom in, we broke it. We did a test. We failed. We came up. Now we did another test. So we're going through this really hard sideways pattern here with copper. All right. Our trade allows us to adjust this and just kind of go where it goes, but I think the odds favor it going higher. If we look at oil, had a really strong finish on Friday. You can see here we're breaking this downsloping move here, this regression channel. We're above the 50 EMA. My big trade, though, for our members was just to fade this move to the downside. It was an easier trade. Now you have to fight it a little bit, but condors, um, call condors work, put condors work, or iron condors work. But I do like them doing them a little bit unbalanced. Right now, I think it's kind of a neutral play in oil. So those kind of trades work out, I believe. Nat gas, well, in nat gas, what goes up typically comes down. I do like this trade right here to the downside. I think there is no divergence in this. Ideally, what we would see in this kind of pattern when you see nat gas moving up that strong is a trade where it comes back here, you get some profit taking, and then you have more people come in, and we have that final blow off top right here, giving us an Elliott wave 3, 4, 5 pattern. And then right at that point there, we get our pirate's face on because there's gold in there, so we put our pirate's patch on. Right there's a pirate's patch, and then we just come in here and we want to sell the hell out of that thing, right? But I don't know if we're going to get that pattern. You can front run this thing by doing a really tight spread. You want to do it in nat gas futures. You do not want to do UNG. There's no premium in it. Okay. But even a little bit of an Elliott wave 4 move can be a nice home run in this trade. And you're only in it for about a week or two. And you take the counter move because nat gas has a hard time holding these highs here, right? If we just step it out, let me put it on a weekly chart and let me just show you what I'm talking about here. So if we put it on a weekly, right, and then we'll just go out weekly and let's just zoom out a little bit. You can see here, these are the resistance points. The last time we were at this level was back in 2018, December 2018. The last time we blew through that level was 2014. So folks, this does not happen very often. Can we go higher? Absolutely. But it's very difficult. And as you can see, when we get up there, we do not stay very long. Now keep in mind, each bar is 1 week, but it's just the backside of that move is very ugly. It always is. So, and the backside of that move can be serious money if you're running spreads, bear put spreads in this thing in that gas. Okay. You just have to be willing to hold it and manage your risk in it. Don't over position size the thing. Okay. So, folks, that's kind of where we're sitting right now. Members, I will see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in. We're having a lot of fun. Everybody, have a great weekend. All my best out to September 9/11. It's this day today, so honoring all the people and the heroes that participated in that, and just everybody stepped up is really a good thing. All right, everybody, have a great weekend. Members, I'll see you this Sunday evening for our weekly market watch. Take care, folks. Ciao.